Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. And I will call you all either the 1% or aspiring 1%ers because what I'm showing you here is what the 1% can do when it comes to paying off debt. And that's me, according to ChatGPT, right? So this is my paid off mortgage statement and me paying it off under 3 years, 2 years and 9 months, literally, right? Or maybe 10 months. I don't know. I don't even care. But if you take a look at this here, maturity date 2051, and then you take a look at the statement date 2024, you just do the math, subtract 30 years. That's when you know the first payment's due, and you're like, whoa, like mortgage is paid off under 3 years. That's right. Total amount due, lien position one. And once your debt is paid off that quickly, then man, it's like cruise control. And to be honest, you're gonna have a what I call rich people problems, or you're gonna be not be able to relate to the average person because the average person is struggling, right? Let me show you what the average person relates with, okay? So if you take a look here, this is a video from a couple years ago, how I paid off $10,000 of credit card debt in 6 months, right? And look at this, 395,000 people viewed it because they relate with it, right? Like if I show them like, hey, I paid off a mortgage in 3 years, you know how many views I get? I get like 300 to 400, which is really good because again, I'm only attracting people who want to be that 1% or aspire, yeah, who are already in that 1%, who are aspiring to be that 1%, right? And just because you have a lot of money does not mean you'll actually get here. Doesn't. You know, a lot of people think, well, if I just had money, that will solve all my problems. Folks, there are plenty of people out there in society who have millions and millions of dollars in a bank account, and because of poor money management, which is a very important skill, they just lose it, right? Debt management, cash flow management, money management is an important skill. And the easiest example of people who are like this are like, retired athletes. And if you didn't know, the average lifespan of an athlete is like, especially NFL players, like only about 3 years. So they make their millions in 3 years and then they're gone and then life is over for them, right? Because no one gave them a foundation of what to do with all that money. It's the same thing with like NBA players, although they have a longer career span. Um, what else? Did I say lifespan? I meant career span. Um, lottery winners, right? Like, here's the thing: what happens when you have a lot of money and you don't know how to use it? It's like basically being given Excalibur and you're not King Arthur. That's really what happens. Like, all right, well, yes, Excalibur is a powerful weapon when it's in the hand of King Arthur, but if you're not going to be King Arthur, that Excalibur, which is in this case a line of credit, is going to be incredibly useless. That's what happens with a lot of people. In fact, let me just ask ChatGPT this. I'll say, what is the average career span of an NBA and NFL player? Okay. 4 to 5 years, 3 to 5 years, right? So let me just play this.
The average career span of an NBA player is typically around 4.5 to 5 years, though this can vary significantly based on factors like health, skill level, and position. Star players and those with exceptional longevity can play much longer, with some having careers that extend well into their late 30s or early 40s. For NFL players, the average career length is shorter, around 3 to 3.5 years. The NFL is a more physically demanding sport, with players facing higher risks of injury, which can shorten their careers. Positions like quarterbacks tend to have longer careers, while positions with more physical contact, such as running backs or linemen, often have shorter careers.
Is it just me or do pro athletes go broke after retiring?
You're definitely not alone in noticing that many pro athletes struggle financially after retiring. While not every retired athlete goes broke, it is a well documented trend. Studies show that a significant percentage of professional athletes, especially those in high revenue sports like the NBA and NFL, face financial difficulties within a few years of retirement. Several factors contribute to this phenomenon. One, lifestyle inflation. Many athletes experience a lifestyle shift after they begin earning large salaries, spending money on luxury items, expensive homes, and lavish lifestyles. When the salary stops, the expenses often remain high. Two, lack of financial education. Many athletes, especially those who come from backgrounds without financial literacy, are not properly educated on how to manage their wealth, save for the future, or make sound investment decisions. This can lead to poor financial choices. The three, short career span. With a relatively short career, as we discussed earlier, athletes may earn large sums of money early in life, but don't necessarily plan for the long term. A 30-year-old athlete who retires may still have decades of life to fund. 4. Bad investments and scams. Unfortunately, many athletes fall victim to bad investments or scams, often due to a lack of financial guidance or because they trust the wrong people. 5. Family and social pressure. Some athletes support large extended families or live under social pressure to continue a certain lifestyle, which can lead to financial strain post retirement. 6. Health issues, especially in physically demanding sports like the NFL. Health problems can arise after retirement, leading to medical costs or the inability to work in other areas. Overall, while not all athletes go broke, the combination of these factors means a significant number of them do face financial difficulties after they retire. Financial education, good advisors, and long term planning can help mitigate these risks.
Right. And so here we are talking about lack of financial education, and the biggest impediment to having an easy financial life is just really just debt, right? That's all it is. And so what we're going to do is learn how to manage our cash flow and eliminate debt. And that's what we're going to do today with velocity banking. So what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. And our goal is to eliminate all this debt and to free up cash flow. Okay. So this is what we're going to do. Let's add up how much debt that we have. So first, let's do the credit card. So it's 5 plus 8 plus 7 plus 10. That's going to be 30K of credit card debt. And then let's figure out what total debt that we have. And so that's 30 plus 23 plus 300 plus 30, right? So I think this is 30. This is 30. I forgot to add that. So now that's 383K of total debt. Okay. Now we're going to assume something very unrealistic is that we have an access to a line of credit that's free and clear. Now, when people get into velocity banking, right, what happens is that if they have a $150,000 um, limit on their line of credit, what usually happens is they have like a maxed out balance. But we did do an actual demonstration of a person who sent their a financial spreadsheet of 22 debts and had only $4 left over in savings. And we went over that in our live stream only for YouTube channel members, 99 cents of what would happen when you had a maxed out line of credit, but we won't go over that today because we want to make the demonstration really easy. But let's just assume we have a maxed out, I'm sorry, not a maxed out, a line of credit for us available to use. And the difference between the average American and the velocity banker is that we're going to make our line of credit as our main operating account, right? That's the big difference here. It's not just about having a line of credit, it's about making it our main operating account. So if we take a look here, this is my first lien HELOC that I have, $267,000 available for me to use. The limit's 280. And so what we're going to do is we're going to shuffle some debt, kind of like doing a balance transfer on a credit card. And again, you just use it like a credit card in a way. But the banks will actually lend you your a line of credit. Again, it's a financial tool. You can borrow money, pay it back, and use it over and again. And they'll give you huge limits if you offer your home equity as collateral. Okay, so let's go ahead and do this and assume that maybe we have a small home equity line of credit. Okay, so let's just assume that we have maybe like, I don't know, we'll make it really easy. We'll say 60, literally $60,000. Okay, So somehow we were able to get a $60,000 home equity line of credit, even though that's not realistic because look at your DTIs, man. Look at how little savings you have. If the bank sees this and say, hey, you want a home equity line of credit? They'll be like, I don't know. And why is that? Is because banks don't lend money to people who need it. If you want to know how the banking game works, it's a risk management game. So they like to loan money and credit cards to in general, low what they who they consider to be low risk people, right? They're not risk takers like some entrepreneurs are. They're in the risk management game, kind of like an insurance company, but they play the game in a slightly different way by loaning out money. Okay, so remember that, and that's how I have over $527,000 in lines of credit because I understand what they're looking for. And if you have the attitude, well, I don't want the bank to really, I just want to get the money and then rip them off. Well, they understand a lot of people are like that because 90% of business credit applications, they already know this, are fraudulent. They already know that. So that's why they try so hard to reject you at the gates, right? Like when you fill in your application, it's like the 5 second like wait time and the spinning wheel, and then they just reject you because they were trying to get rid of 90% of the population and only lend to the 10% who are worthy. That's how a bank works. And so if you're like, how do I get a line of credit now? I have no clue. I literally have no clue. But if you know how to play the game right, then you can get over $527,000 in lines of credit, and I'll probably get more soon. Okay? All right, so let's go ahead and do this. And we're going to assume two things. Number one, the same income. But number two, this is the part where a lot of Americans struggle with is that we're not going to have a savings account. This savings account is always going to stay zero. Our checking account statement will always stay zero because our money is going to be dumped into the line of credit. It's going to be an overpayment into that line of credit, right? So that's something that we have to keep as a habit or form as a new habit because a lot of people struggle with this, right? So you take a look here, at my checking account summary, every time I begin, there's a zero, and then every time I end, there's a big fat zero because I'm dumping all of my money into that line of credit, all of it. Okay, and so let's go ahead and do this. I'm going to copy and paste this, and then I'm going to copy and paste this, right? And then now we have something called cash flow, right? Which is almost the same thing as our savings. But remember, every time your savings statement or checking account statements comes out, it should be a big fat zero at the ending balance or maybe close to it. If your bank doesn't like it if you don't carry a balance at all, right? So what we're going to do is shuffle some debt to increase this thing called cash flow. And let's do this because this is an 8% line of credit, okay, we definitely win by taking out loans and credit cards that have a higher interest rate, right? Like if you want to know the ultimate cheat code of which debts to move, it's usually the short-term loans and the higher interest rate credit cards, right? So let's go ahead and move all this. So I think this is $60,000 in total, literally the amount of the credit limit. And then let's go ahead and do this. So this is now 0, 0, 0, 0, 0, right? And so how do we get from $613 of savings to zero savings, but $2,279 of cash flow? Holy bazookas, that was so easy, right? So, all right, so now what we're going to do is calculate the next month's balance, which is the previous month's balance, plus the previous month's interest minus our cash flow, which is 2279.76. And then what we're going to do is we're going to take the average daily balance, right? Let's go ahead and do that. Take the average daily balance, okay? Average daily balance is about 58 grand. And again, the interest is calculated on the average daily balance multiplied, okay? Multiplied by that interest rate. So let's go ahead and do that, which is 0.08, right? And so you might be thinking, $4,000 of interest in 1 month? No, it's 8% divided by 12, right? So you don't pay as much as you think, and that's why a lot of people get freaked out. So let's go ahead and do this and copy and paste this, and we see that, um, wow, this debt is just going down, 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 right? And so scroll down even further, and then we see in 29 months, all of this debt is paid off. So what just happened here? We put our entire $6,500 into that line of credit. Minimum payment gets satisfied. Interest gets lowered because it's based on the average daily balance. And then we take our expenses out to 4,200 when we need it. And after every single month, the balance goes down by $2,279. And if we need any sort of emergency fund, our emergency fund is the limit of our line of credit minus our balance. That's all it is. So every single month, your savings account literally is growing because your savings account is your line of credit, right? So that's what we're doing today. And again, so let's go ahead and we're going to go here and mark in 29 months we paid off 60K of debt, right? 60K. Okay. So wow, that was really easy. So less than 3 years. Okay. So now next one is our auto loan and our mortgage. So we have our loan calculator right here. So we already eliminated this personal loan, so this is now zero. We don't have to worry about that. But let's just do this 29, 29, and then we have uh, what is our, what's it called? Current balance of the loan, right? We see how much interest we paid so far. And what we're going to do is we're going to take this 12 grand and move it to the line of credit and free up that $455 of cash flow. So if you take a look here, there's something called the CFI, cash flow index. If you ever just do a quick Google search on the cash flow index, you could see it's the loan balance over the minimum payment, and a low number under 50 means it's inefficient, meaning let's go ahead and pay it off first. So if you want to go ahead and take a look at that cash flow index explanation, I recommend you going through Google, but since this is a very low number, I'm going to go ahead and I'm okay with paying it off into line of credit. So let's go ahead and do that. Control V, and then paste the values, and then now I'm going to add 12881.08, right? And now what's the line of credit? Uh, I'm sorry, what's the cash flow, right? So this is now zero, and now our cash flow is $2,700. This is amazing, right? Look how easy that was. Life is easy when we don't have to worry about car payments. And we could just get rid of it. So it's 2735.19. Okay. And then now let's see how long it takes for us to get rid of that car in about 34 months. 34 months. Wow, that was so easy, right? So now that literally just took us 5 more months to get rid of that car loan. And so now that's, believe it's 83K. And now it's time for us to focus on the mortgage. So 34 months, right? Let's just go down here. Um, Hold on, give me one moment. All right, and so what we do here is we just put 34 months, right? So now this is paid off. These two are paid off. You can see that it has a very high cash flow index, and what that means is that it's not a good idea to replace this loan with a line of credit, especially if there's an interest rate difference, right? We don't want to do that because if I pay this $281,000 off, I only get $1,200 of cash flow. But we have to understand little nuances like if the loan sucks up such little cash flow, that means you're going to pay a lot of interest, right? If this cash flow index is high, that means you're going to pay a lot of interest. And if the cash flow index is low, it means it sucks up a lot of cash flow, but you don't pay that much interest, right? That's why car loans, only for 5 years, you don't pay that much interest. So let me go ahead and do this and type in 360, and you'll see that after the 30 years of the loan term, you pay $155,000 of interest, right? So we go back here. So the latest balance is $281,000, and let's just go ahead and put it in the velocity banking calculator. Give me one moment to pull that one out. All right, so now we got our velocity banking calculator up and running by Renata. So this is just a calculator provided by them. So if you are interested in getting this calculator, I actually sell Renata's Education as an independent contracted marketer. Um, so this is where I originally learned velocity banking from. And if you take a look here, you just plug in a number, 6.5 years, 29 grand of interest, sweet. Now, the thing that you have to learn about this is that if you decide that you're going to replace the mortgage with a line of credit, like some people do on the internet or promote, take a look at this. You only save 28 grand of interest. But if you just do it in small chunks with like $7,000, you save 100 grand of interest. So which would you rather do? A first lien HELOC where you replace the mortgage, or you just kind of do it in little chunks, right? Like chunk amount, and just get rid of that loan or get rid of the loan in pieces, right? Much easier to do it that way, much more simpler. And so what we're going to do is we're going to just kind of do this, or take this 6.5 years, multiply, or not multiply it, multiply it. Do the math here. So 34 divided by 12 plus 6.5. And that is 9.33 years. And we're going to call it the easy life, right? That's so, because the easy life is a debt-free life. And then this now goes to zero. Okay. And now it's $4,000 of cash flow per month, but because we don't have any debt anymore, now we're going to actually have savings. So $4,000 a month, month one, $8,000 a month two, $12,000 a month three. And then now you're going to be like, one of those people are like, I have money in my savings account. What do I do? AKA rich people problems. So it's good to have these problems. And that's kind of the problem that I'm having right now, which is, rich people problems. Mortgage paid off. And here's the cool thing about when you are in a position where you don't need money, that's when the banks lend to you because banks don't lend money to people who need it. How do you think I got this huge home equity line of credit? Because I understand what they want and they don't lend money to people who need it, right? So, okay, well, that's it for today. So just probably, I might make another video for today. I don't know, because again, we're in the easy life right now, and this only takes me about 15 to 20 minutes to crank out a video. But other than that, have a great day, everybody. It's Korean Atlanta Mentorship.